Hi candidates, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, your lecturer for Financial Reporting and Advanced Financial Reporting. So in this session, I want us to look on topic number 4. And in this topic, the topic is analyzing financial statement. So in this topic, you're going to look on 4 subtopics. The first subtopic you're going to cover is the topic regarding computation of earnings per share in accordance with the International Accounting Standard number 33. Subtopic number 2 is related party disclosures, where we are going to define who are related parties, and also we see the information which a company is expected to disclose as far as the related party transactions are concerned. Subtopic number 4, we're going to look on preparation of a segment report in accordance with IFRS 8. And then finally, we are going to look on financial reorganization and reconstruction. And basically in that particular subtopic, you're going to look on 2 ways in terms of how the company may restructure. That is the internal reorganization or the capital reduction, and what we refer as the internal reorganization or internal, that is external reorganization, or basically the external what? Reconstruction. So therefore, here we are going to look on those 4 subword topics. So I want us we go straight to topic or to subtopic 1, which is regarding the computation of earnings per share, that is EPS. And in this topic, we're going to look on a number of issues. 1, we are going to define what is earnings per share. Number 2, we are going to look on the significance. What is the benefit of the company computing the earnings per share? And then from there we proceed and we look on the 2 types of the earnings per share to be computed and disclosed by the listed companies, and that is the basic earnings per share and the diluted earnings per share. So mean that by the end of the day, once we are through with the with this particular topic, you must be in a position to define earnings per share, to know the significance of earnings per share, and also to compute the basic and diluted earnings per share. But I want us to start by defining what is earnings per share. And EPS basically refers to the amount of profit or the amount of earnings which is attributable to each ordinary share issued by the company. Is the amount of profit which is attributable to each ordinary share issued by what? By the company. So therefore, here we can say EPS, this is amount of profit or earnings attributable to each ordinary share issued by a company. It is the amount of earnings, or basically the amount of a profit which is attributable to each ordinary share issued by what? By the company. Basically what you have said is that all listed companies, and these are those particular companies whose shares are trading in the securities exchange market, it is a requirement that they must compute and also disclose the earnings per share as part of their notes, as part of the note to the financial statement. So we can say listed companies are required by IAS 33 to compute and disclose earnings per share. So by disclosing mean that this particular earnings per share which is computed, it should be part of the notes to the financial statements. Now, what are the significance, or basically what are the importances, or what are the benefits of this particular earnings per share? So let's look on the significance, or in other terms, we can say that these are benefits of earnings per share. So once this earnings per share is computed, how is it important to the company and also maybe to the shareholders and other stakeholders. Number one is that earnings per share helps to compare financial performance of an entity over time. Basically, what that means is that as a shareholder of a company, you can be able to use this particular earnings per share to compare the performance of the company over a number of years. Basically, to know or basically to compare the profitability, how the company has been performing over a number of years. Number two is that this particular earnings per share also helps to compare. Maybe we can talk of profitability of different entities. To compare performance of different entities. So mean that the earnings per share can also be used in terms of comparing performance of company A and performance of company B. Number three is that the earnings per share is also used. We can say it is used in computing. It is used in computing the price earning ratio. It is used in computing the price earning ratio. So the price earning ratio, this is basically a ratio which is computed by taking the market price per share, and then we divide that with the earnings per share. So to compute that ratio, definitely you need to have the earnings per share. And also this earnings per share, we can say, is used by shareholders to know the amount of profit generated for each share held. In the company. So as a shareholder of the company, you can be able to know the amount of profit that particular company was able to generate for each share held in that particular company. So therefore, those are basically some of the significance, some of the benefits of the earnings per share, which we are saying must be computed, disclosed by all the listed companies. So before we look on how we compute the earnings per share and also the different types of earnings per share, first of all, I want us to look on definition of various terms. So some of the terms we need to define here. Number one is something called the potential ordinary shares. This one are abbreviated as POS. And this refers to any contract which has been entered into by the company or any other form of financial instrument issued by the company and which requires the company to issue ordinary shares in the future. So we can say it is a contract or financial instrument requiring an entity to issue ordinary shares in the future. So examples of this include stock options. Stock option is a contract between the company and the employees that for the company to issue shares to the employees in future at a price below the market price. Another good example of this is convertible securities. Convertible securities, e.g. convertible debentures. If you acquire convertible debentures of the company, then you have the right to do what? To convert them into ordinary shares. Those are good examples of the potential ordinary shares. So the other term which you also need to define here is an option. And warranties. So options and warranties, on the other hand, these are those particular contracts which requires the company to issue ordinary shares in future at a price which is below the market price. A good example is whereby the employees of the company will be given a privilege or basically a right to buy the shares of the company in the future at a price below the market price. So therefore, we can say that this is a contract, requiring an entity to do what? To issue ordinary shares, in future at a price below market price per share, at a price below market price per share. So that is basically the other term which you must be in a position to define. The other term is something called the contingently issuable shares. So when we talk about the contingently issuable shares, basically we say that these are those particular shares which are issued by the company in the future, either at no consideration or at nil consideration or at little consideration, once certain specified conditions have been met. For example, in this case, the company can promise to issue shares to its executive, or basically to the executive managers, if the profit of the company exceed a certain amount. So mean that once the profit of the company exceed a certain amount, then the senior managers will be issued with the shares of the company free of charge. So basically, this is something which is exercised by most of the companies. For example, if you check company like Safaricom, company like Equity Bank, they ordinarily issue shares to the senior managers once the profit of the company exceeds a certain amount. So therefore, we can say that these are shares. These are shares issuable in the future, or issuable at nil, or retro consideration. Once specified conditions are met. Once specified conditions are met. Yes. So that is the other term. The other term we need to define here, number 4, is the term dilution. So dilution, basically these to dilute is basically to reduce the effect of something. So therefore, this is the reduction in the earnings per share, or basically the increase in the loss per share, on the assumption that the potential ordinary shares, e.g. convertible debentures, or maybe stock options, have been converted into ordinary shares. So therefore, you can say that this is the reduction in profit, or basically let's talk of in earnings per share, or increase in loss per share on the assumption that potential ordinary shares which are abbreviated as POS have been converted into ordinary shares. We refer to that as dilution. The other term is anti-dilution. So anti-dilution now is the direct opposite of dilution. So mean that anti-dilution now is the increase in earnings per share or decrease in loss per share, on the assumption that POS have been converted into ordinary shares. So we can say that this is increase in earnings per share, that is EPS, or decrease in loss per share, on the assumption that potential ordinary shares, POS, have been converted into ordinary shares. Have been converted into ordinary shares. So basically, these are some of the terms which you must be in a position to define. You may come across a question whereby the examiner is requiring you to define some of this particular word term. Like there was a question which was there in the past papers, and that question was requiring the definition of the potential ordinary shares and the contingently issuable shares, and still the question there was requiring the definition of the term what or the explanation of the term what, dilution. So therefore you must be in a position to do what, to define any of those particular word terms. Equally, you should be able to remember those particular word significance. So here is today's assignment. Question number 1: why is earnings per share, EPS, considered a crucial metric for investors when evaluating companies' performance? Number 2: how does earnings per share help shareholders in assessing the profitability and growth potential of company over time? 3: what factors can influence a fluctuation in earnings per share, and what implication does this fluctuation have for investors? Question 4: explain the concept of potential ordinary shares and how they impact the calculation of earnings per share. 5: what are options and warranties in the context of EPS calculation, and how does they affect the number of outstanding shares? The other question: define contingently issuable shares and discuss their significance in calculating the diluted earnings per share. The other question: what is meant by dilution in context of EPS, and how is it important for investors to understand its implication? The other question: how does stock option, warrants, and convertible securities contribute to dilution, and how is this reflected in earnings per share calculation? The last question: explain the concept of anti-dilution and provide examples of measures companies might take to prevent dilution of earnings per share. So that is today's assignment. I want us to take a short break, or basically we take a break. Once we come back in our next session, we are going to look on the types of earnings per share to be computed, and then from there we start by looking on the computation of the basic earnings per share.